Thank you, sir. It is now my privilege to introduce our next speaker, Shri Tarun Ramadorai. Shri Tarun Ramadorai is a professor of financial economics at Said Business School, University of Oxford. His areas of expertise include asset pricing, international finance, hedge funds, and household finance. Shri Tarun Ramadorai is also a member of the executive committee at the Oxford Mann Institute of Quantitative Finance, a research fellow of the Centre for Economic Policy Research in London, a founding senior fellow of the Asian Bureau of Finance and Economic Research, and an economic advisor to the European Securities and Markets Authority, the supranational capital markets regulator. During 2011 and 2012, he was a visiting scholar at the Economic Advisory Council to the Prime Minister of India. I now call upon Shri Tarun Ramadorai to discuss the idea of the Public Debt Management Agency as a new merchant banker for the government. Ladies and gentlemen, Shri Tarun Ramadorai.
Thanks very much for having me over here to talk about the Public Debt Management Agency. I'm an academic, as you probably heard already, and so what I'm going to try to do is to give you some very basic, from the ground zero academic frameworks for thinking about optimal public debt management. Because the debates that we've been seeing so far are coming from a place which I think is not necessarily grounded in the fundamentals of what public debt management are, but what we'll see is we very quickly get back to some of the current conversations that are being had. And hopefully what I'm going to try to do in the next 10 minutes or so is to try to put us on a relatively firm foundation economically for thinking about this. So bear with me. This will be a sort of academic lecture to begin with, but very quickly we'll get into slightly more practical realities. So if you were to think about optimal government debt management, the theoretical issues, if you talk to any student of economics from the postgraduate level, basically boils down to one single thing, which is this question of Ricardian equivalence, which comes from this economist called David Ricardo, who was around many hundreds of years ago at this point. And Ricardian equivalence basically says that debt is nothing other than future taxes. Debt and future taxes are exactly the same thing. If you raise debt, that probably means that in order to repay it at some point, you've got to raise taxation at some point in the future. And of course, we know that raising taxes is complicated because we don't have lump sum taxation. If we don't have lump sum taxation, changes in tax rates can introduce all kinds of distortions into the economy. So basically, the goal of any debt management should be to smooth any changes in distortionary taxation that you do over time, over a long period of time. So another way to see this is that what you should really be doing in optimal debt management is you should be providing insurance against having to raise income taxes following adverse spending shock from the government or a productivity shock. So if you think about if you think about a financial crisis, what ends up happening is that the government basically has to go out there and raise some money. If it has to do it by raising income taxes, people don't feel happy in having income taxes raised when times are bad. Ideally, what you should have done 10 periods earlier is to set up an optimal debt structure so that you didn't have to get into that situation in the first place. And that's really the fundamental principle of what government should be thinking about. Now, the ideal theoretical solution is to issue debt which basically has low returns in bad states of the world, and this is called state contingent debt, but these contracts don't exist in the real world for a variety of pretty standard reasons. So what you need is you need to operate this kind of system in a world in which you have standardized debt contracts, and standardized debt contracts are important because of liquidity, because you want to minimize financial innovation costs, and so on and so forth. Okay? So state contingent debt is an unworkable solution. So what you need to do is actually get to the optimal solution by having portfolio management of debt. So in the real world, what you actually have the government facing is a very complex debt portfolio management problem with these liability constraints, because the government obviously has to go out there and spend, and therefore in order to make this happen and to satisfy the conditions of Ricardian equivalence and to smooth distortionary tax rates, you need to really understand your debt portfolio management problem. Now, this problem gets really complicated very quickly because there is lots and lots of different things you have to consider. So if you were thinking about the portfolio management issues when it comes to optimal debt management, First, you want to think about whether there's nominal debt or inflation index debt. I'm not going to bore you with the details, but basically, you need a mix, an optimal mix of nominal debt as well as inflation index debt, because different kinds of shocks that hit the economy demand different types of debt. So for example, public spending shocks, nominal debt is optimal. If you have a set of monetary shocks hitting the economy, then index debt might be optimal, and so on and so forth. So the balance of shocks is going to determine the balance of debt that you have in the economy in terms of nominal versus real. Currency composition introduces additional complexities into the equation because it depends on the correlation of how foreign and domestic output shocks are correlated and monetary shocks are correlated. So again, the optimal policy has a mix. So now you start to see that the optimal public debt management problem is very complicated. You have to deal with these issues of, do I issue nominal or real? How much do I issue? You've got to deal with the issue of whether you issue foreign or issue domestic. And again, there's lots of different conflicting answers. You've also got to deal with the question of the optimal debt maturity. Do I issue short-term or do I issue long-term? Okay, so short-term debt sometimes can be cheaper for a government to issue because people demand liquidity at the short end of the term structure, but if the government keeps issuing short-term debt, it has this rollover risk because it has to keep going back to the market and getting refunding, and that can sometimes be quite complicated for the government to do. So this is another tricky problem that makes optimal debt management even more complicated. Okay, so I'm hoping that I'm giving you a sense that optimal debt management it's not a no-brainer. Okay, I mean, this is a seriously complicated issue, right? Now, there's one issue that's been coming up over and over again in the debate in India about whether the RBI should be doing optimal debt management or whether the government should be doing optimal debt management. And this issue is this issue about, well, the RBI is setting interest rates, it has some inside information about these things. Everybody will feel uncomfortable about buying debt if the RBI is issuing it because there's this adverse selection issue that the RBI has more information than the government. I think that this is a red herring, okay? So this is just there to distract you. I think this is a complete non-issue. I really don't think that the debate should be concentrating on this issue at all. I mean, I think people have been sort of really focusing on this issue. Why? Because there are huge reputational costs. So the RBI only has to screw around with people once. And then after that, it gains a reputation for issuing debt when it has some inside information, and then the game is over after that. Nobody ever believes the RBI ever again, so credibility completely changes after that. So it doesn't make any sense. Of course, the other thing is, even the fiscal authority, so the government also has inside information about fiscal policy. So if you have this issue about monetary policy with the RBI, you have the issue with fiscal policy with the government, so it's basically a wash. I mean, it doesn't really matter for this particular reason whether you have debt management in the RBI or in the government, okay? And by the way, it is true also that even when you have very adverse growth crises and high levels of debt, there's very little evidence in most economies that we've seen that high inflation actually exists. So I think this is sort of the issue that shouldn't be really thought about, but there are all these other complicated issues to think about. So let's sort of try to summarize and sort of see where we come out, okay? So the main issue one is that optimal debt management is linked inextricably with the conduct of fiscal policy, okay? Because it's this trade-off between optimal taxation and debt levels. So if you really want to think about this, this is a problem which needs to be thought about simultaneously with fiscal policy. This gives you some sense that it probably should be in an agency that's sponsored by the government. It's one reason why it's true that in the US and the UK and most developed economies, public debt management is done outside of the monetary authority because it's such a fiscal issue. It's done usually within the treasury or the exchequer in these economies. The second one is it's a complex issue, okay? It requires serious asset management capability. I don't think any institution in this country right now has the kind of asset management capability that is required in the government to actually put this together. What that means is whatever agency you constitute, you have to really invest very heavily in this agency and make sure that public debt management is taken extremely seriously. And that probably suggests we want to build up a new institution from the ground up as well. Now, an open economy does mean that you need institutional knowledge of foreign and domestic money markets, and at the moment it is true that that's in the RBI. Now, I don't really know what the solution to all of this is. I mean, it seems like it really should be the case that we have a separate public debt management agency. I think you won't find too much argument about that point. But then maybe in terms of a glide path, what you could do is you could incubate the new public debt management agency in a pre-existing institution, whether that's the RBI or whether that's MOF, but with a clearly defined path to spinning it out and then developing those asset management capabilities independently. So I think this is the sort of measured debate that we really need to have right now. This is a bunch of references. If you're having trouble sleeping at night, I would strongly recommend these. Okay.